Hello, this is Corner Invest. So the streets are bearish on these stocks. So in today's video, we'll be covering a few things. We'll be covering the stocks that the streets are bearish on, Tesla stock, as well as some questions that you guys have left me in the comment section below. So let's talk about the first stock first, which is none other than Google, Alphabet. So Google over here is currently trading at around 19 times earnings, and it just beat its earnings estimate by around 50% or so. And if you're to account for the unrealized gain that they had in terms of the net income, they still beat the street's estimates by around 6% or so. So it was quite good in terms of its earnings as well as the revenue. They both came in higher than expected. And overall, the report that they had a few days back was quite remarkable. But this stock nearly closed flat on Friday. So this is Josh Brown. Josh Brown has sold his Google shares and is buying back Netflix using all those funds. Let's see what he said.
Brings me to Josh Brown, who has made some interesting moves today that I wanted to have a little larger conversation about where we stand before I get to that. So, how long have you owned Alphabet, which you sold today? I'll talk about what you bought, or you can, but you've owned it for a long time.
Yeah, I had sold earlier this year half my position, which we talked about a couple of times on the show. I don't know where that was, in the 180s, the 190s. I sold the rest, and I think that Alphabet will be fine. Not everything is an extreme. I'm not in the camp that thinks Alphabet's going to lose the AI race, or it's got like this fundamental issue with all of these large language models taking away from the use of search. I think they will be one of the top AI services, but it's never had to compete the way that it does now. And younger generations are jumping literally right into ChatGPT when they want to know something. They're not looking for blue links and sponsored links and ads. They just want the answer. And so like Google's going to have to come up with an answer to that. And I think that's reflected in the multiple that the stock now sells at. I think other people understand that. This is not a unique insight to me. But I think it's going to be a defensive year. And I think, when you look at who is most reliant on advertising revenue amongst large cap tech, it's really Meta and it's Alphabet, and arguably the Meta mode around Instagram is stronger than the Google mode around Google search. So I think it's just that simple. I wanted to do something more defensive. And so what I bought instead of Alphabet in that category is Netflix. You want me to pause here so you can...
Yep, so he's basically said that he's sold his Google position and he's now pumping all that capital into Netflix, a company that's trading at around 45 times earnings. But to trade a company at 17 times earnings for another company that's trading at 45 times earnings is just wow for me. So this is what I mean by price follows sentiment. So at all-time highs at $208, when Google was trading at all-time highs this year, no one was talking about how LLMs will take over Google's market share. Before then, before it went up to all-time highs, everyone was talking about how LLMs, they will take over Google's market share. And then as soon as it went to all-time highs, everyone was celebrating the stock. And now at $160, everyone is talking about how the LLMs will take over their market share, how the antitrust case is backhang for Google, and how Google is going to basically lose the AI race over the next few years. So a few things. LLMs is for research purposes, Google is for consumer purposes. So what Google does and what Google does best is by presenting consumer picks to its user base. So for example, let's say if you're searching for a restaurant, you're searching for like, let's say a hotel, Google makes the most money from that. Whereas for LLMs now, they are more for research purposes. Of course, your LLMs, they could evolve into something like Google next time. But Google has always faced competition from other companies like Amazon, Meta, Instagram, and all your different other search platforms as well, outside of just the normal generic Google search. So of course, out of the search engine platform, Google has a monopoly. But if you're to consider TikTok, Amazon, Instagram, all these different companies, they form the search market share as well. So competition is nothing new for Google. You're clearly seeing what Google is doing with their LLMs already. So Gemini is doing quite well. It has already had around like 350 million subscribers already, and we could continue seeing Google integrating AI into its search itself. So AI overviews, it is monetizing as well as the standard Google search. So I don't think Google is losing the AI race, and you're not seeing it in the numbers as well. So this is Google's fundamentals over here. In Q1 of this year, they just reported their earnings a few days back, and Google services revenue, which includes the Google search portion, increased revenues by 10%. So this shows strong performance across Google search and others, Google subscription platforms, and YouTube as well. So YouTube itself, it's a business that is easily already worth $500 billion. And if you were to just consider Google's entire market cap, which is around $2 trillion, Google's YouTube is already one quarter of that business. And then you have Google Cloud as well, which is posting around $2 billion of net income this year. And $2 billion times around a 40 times multiple for that business, that's another 80 billion already. And then you have all your other portions as well, including your subscription side, as well as some other bets like Waymo itself. So if you're to do a by parts analysis for Google, I think this stock is just extremely undervalued. There's no reason for this stock to trade at 17 times earnings. I think it deserves around a 24 times earnings. Let's see how this one goes. So this is Google's valuation over here. So I put in the EPS that is adjusted based on the latest report, which is $8.12, or the reported EPS, which is $8.96 for the trailing 12 months. So if you're to assign a 20 times multiple for Google over here, this company is yielding around a 13% CAGR over the next 5 years on the conservative side, and a 15% over the next 5 years on a more base case side as well. So you can clearly see that Google is a company that is primed to outperform the market over the next 5 years. And if they can defend their search business, then you could easily see this company doubling over the next 5 years or so. So for me, I think Google is a buy. It's one of my positions. Maybe I'm biased, but I feel it's a strong buy today. Next company is Adobe. Adobe is a stock that is hated by the markets. Over the past 3 years, 4 years or so, this stock is flat. So currently now it's trading at around a 24 times earnings, and it's around close to its 52-week low over here. So year to date is down around 16%, and at the lowest point itself, it was down around 30% year to date. So for Adobe over here, this is the story. So it is a similar story to Google, whereby your Gen AI is taking over Adobe's market share, growing exponentially as well. And then you have other competition in the space as well, like Figma, Canva, and Adobe is raising prices so quickly that the consumer is basically fighting back right now. So Adobe, every single year, almost every single year, they will increase the prices of their products by around 10%. So 10% revenue growth for this company is derived slowly by pricing power. And when the price of the products goes to such a high extent that it is unaffordable to the consumer, that is when you see the earnings of Adobe coming back down. So this is Adobe's fundamentals over here. This is their earnings at the top, and then the P ratio at the bottom. Earnings has accelerated over the past few years. You can clearly see in the numbers that this is not a struggling business by any sort of means over here. So over the past 10 years, it's been growing and growing and growing non-stop. And you can see in the price to earnings ratio over here, it is currently now trading at one of its lowest points as compared to its history. The only other point where it traded this low was in 2011. And in 2011, I don't believe that they had a subscription business model. They had a one-time payment business model. And currently now, their business is more of subscription based rather than the one-time payment ones. So currently their business model is a lot more predictable than back then, and the valuation right now is similar to back then when it was just a one-time payment company over here. So for Adobe over here, this is their buyback yield. So they bought back a lot of shares in Q1 of this year, $11.4 billion of buyback. And if you're to analyze it, it was around a 5% buyback yield for this company. So just putting in the numbers, just playing around with the numbers, if Adobe has a buyback yield of around 5%, and if let's say they dilute the shares by around 1% or so, and they have an earnings growth of around 11% or so, they're projected to grow revenue by around 10% every single year over the next 3 years. So 11% is definitely doable. So 11% plus 5% minus 1% of dilution, you can easily see a 15% EPS growth for this company over here. And trading at around a 23 to 24 times earnings for this company, I think it is manageable. But for me, I don't think I'm buying into Adobe simply because it is in a similar narrative to Google, but Google is the stronger story here, and it is the company that is trading at a relatively lesser valuation right now. And Google is the company that has less competition as compared to Adobe. You only have your ChatGPT in terms of Google, but for Adobe, you have ChatGPT as well as all your different other editing software platforms as well. So I've spoken to graphic designers, and Adobe's pricing power is squeezing right now. So what that means is Adobe has increased prices so aggressively that consumer may be starting to push back. And when consumers start pushing back, that is when you see Adobe's sort of like revenue taking a hit. So next stock is PayPal. So PayPal over here is down around 24% year to date, and it is now currently trading at around 16 times earnings. So this is PayPal's story. PayPal's growth is slowing. PayPal is facing intense competition from other payment management platforms like Stripe, Wise, Adyen, and other payment providers as well, including Visa, MasterCard, Apple Pay, and all that. But is 16 times earnings for this company a fair price? So PayPal over here, they recently just released that they will be approving a $15 billion buyback. And if you're to account for PayPal's market cap right now, which is at around 64 billion, this 15 billion buyback program will be around 25% of the total market cap. So for PayPal over here, let's say they can buy back around 7% of their shares every single year. That is 7% in EPS growth already. And if you add that up with another 7%, 6 to 7% of revenue growth, that is easily around a 13 to 14% EPS growth for PayPal already. And so trading at a 16 times earnings today, I think it is more than reasonable for you to basically think about buying into this company. But for me, again, it is a company that is facing intense competition, and that's why I'm not adding into it. But for someone that is a value investor, I think this is a stock that is worth looking at. Next one is LVMH. This company is one that I'm interested in. So it is currently trading now at around a 20 times earnings, and it is right at its 52-week low. So for LVMH over here, they are victims of their sheer size. So they are too big to continue growing at a very fast pace, and growth is now dependent on two things, which is your China recovery as well as the acquisitions that they made over the past few years. So for LVMH over here, the revenue has been declining. So over here, as you can see in their latest quarter, they reported a 11% organic revenue drop in Asia. Asia is mostly made up by China itself. So China revenues are hurting right now because the consumers there are pulling back on luxury spend on foreign products, and they're buying more of their China products over there. And then you can see that over here, Japan, which was their largest growing segment last year, where they grew around 14% or so, is down this year as well. So the consumer in Asia are all pulling back, and then the consumers in US as well, negative 3% is pulling back as well. And then the only growth portion was in Europe. So this is dangerous for this company. When a company is experiencing revenue growth and if there's no operating margin expansion, then you can easily see the earnings coming down by 5-10% or so in this case for LVMH, with a revenue drop of just 3%. So for LVMH over here, here are some of my thoughts. It is a quality business, but the pricing power isn't there anymore. And so for LVMH, for me, it is a luxury brand that is second rated now. So you have Hermes right at the top, and I don't think LVMH has the pricing power that Hermes has. And so they cannot increase their prices simply because they're trying to appeal to all the different masses. And if you're to compare it to, for example, like a Hermes, Hermes doesn't do extensive advertising like this simply because they want to uphold their brand value. They want to only appeal to the top 1% of the top 1% of the entire world. So for LVMH over here, it is a company that is facing two problems. It can't raise prices too much, and the volume is on a decline. But for me, I love this business, and this is when I'll be buying into LVMH. So LVMH is an incredible brand name. This company is like Berkshire in the luxury space. I would like to own it at around $90. That will be my first entry. It is an amazing company that will likely beat the markets if you catch it at the right price. Next portion, I'll be talking about Tesla stock. So Tesla stock, it went up by around 10% last Friday, and year to date is down around 20% or so. So for Tesla over here, it is a retail boost stock. Everyone loves it in the retail community, but the problem with Tesla is simply just the key man risk. So you have Elon Musk over here heading the company, and the problem with Tesla is if Elon Musk leaves the company, then Tesla stock and Tesla's earnings will get hit because the brand is built around Elon. So I hate it when my CEOs get too political because it will definitely hurt the business some way, shape or form, which is what I don't like. So for Tesla over here, you can clearly see that the brand name is getting hurt. But I don't think Tesla bulls are concerned with this because they are more concerned with the long-term story of Tesla. It is a stock that could easily go back up to all-time highs again. But for me, it is not in my investing universe at all because it's all based on hype, not based on the numbers itself. So last portion over here, I'll be talking about some of the questions that you guys have left me. So first guy over here. Hi, great content you are making out here. How about stocks like the Trade Desk as well as Snowflake? So let's talk about the Trade Desk first. So the Trade Desk, they do something similar to AdTech in the advertising space. They're competitors to Meta as well as Google. So for me, I think Meta and Google, they are so strong in the advertising space that they will never be displaced. And for Trade Desk over here, it is a company that is still trading at a very high valuation despite the drop from this year. So currently now it's trading at, I believe, 100 times earnings even after this drop. So this goes to show how extreme the valuation was before that 40-50% plunge from all-time highs. And for me, I think the Trade Desk is simply just an avoid now because I have other alternative in the same space that is providing much better value right now. Next company is Snowflake. So I believe Snowflake is some sort of company that is involved in cloud computing. So again, you have other companies like, for example, Google with their GCP, Amazon with AWS, Microsoft with Azure that is performing much better and doing it at a much bigger scale as compared to Snowflake. So for me, I think Snowflake is a disruptive company, as always been, but there's two portions to the business that I don't like. Number one, stock-based comp dilution is just incredible. It's incredibly large. It is to the point where if you're to price it based on a price to free cash flow basis, the stock is just extremely overvalued. So that's one portion of the management that I don't like. The next portion is simply just they don't have the moat that all your three different hyperscalers have. So Microsoft, Google, Amazon, all these three hyperscalers, they have an impenetrable moat, whereas Snowflake over here, they simply can't compete because they don't have the funds to go and build out all your different data centers like all your three hyperscalers over here. So for Snowflake, I wouldn't touch it as well. It's not a company in my investing universe, and that's why I don't like this kind of stocks. Next one, do you diversify geographically, such as into the Hang Seng Index? So for me, I think China is a country that is worth investing in. I'm quite interested in some of the Chinese stocks right now, namely Alibaba as well as Baidu. Baidu is a company that is similar to Google in China, so it's a search engine in China, and then you have all your different other Baidu platforms as well. Baidu is simply just a valuation play, so the stock is currently trading now at around 1 times price to book. So for Alibaba, it is similar to Amazon over here. They have their retail side of their business as well as the cloud computing side. And if I were to buy into Alibaba, it's simply just for the AI play. So as for whether or not I'm looking into diversifying into the Hang Seng Index, currently not yet. I own some Singapore stocks, that is my diversification, but yes, I'll be looking into buying some Chinese stocks in the future as well, maybe a small portion of my portfolio into those segments. Last portion over here, I'll be talking about Intuit. So Intuit is a business that is a monopoly in the US in terms of your tax invoicing segment. And for me, I think Intuit, it's a business that is high quality, of course, but there are two main concerns that I have with the business. Number one, it is too reliant on small businesses. Number two, it is trading at an extremely high valuation. Intuit is a quality business in the US. It is a monopoly because the only competition that it could possibly have is your government body creating a similar platform to Intuit. But I think that is highly unlikely. So for Intuit, it's a business, it's a quality one. Dev Kantasaria, a super investor, owns as well. But for me, I don't think the valuation has been right for me over these past few years to enter into it, and that's why I haven't entered into this stock yet. Hopefully you guys have found this one useful and invest safe.